Okay, good morning to everybody. It's Monday and we're in week 8 now, and we're going to go get started. And first of all, before we get going, we have a couple people on the Zoom call and in the classroom itself. Any questions about anything that we're doing so far in terms of where where we're progressing, where we're going, what we're doing, etc.? Okay, well, we're in chapter 13. So here's the thing that I was sort of looking at here is the idea that, and I may have to sort of adjust some of the due dates here because I think this is really a critical piece of what we're trying to do in accounting is talking about this idea of cost volume profit analysis. And really, it's bigger than accounting, really. I mean, it's throughout business, this idea of how much do we produce, how much do we do, and what are the profits that result from that. So I think it's a pretty important section. So I may adjust the due dates probably sometime sort of mid next week, that sort of thing, in order to sort of accommodate this, because I really do want to talk more about what's going on here. So anyway, so if you go back to I usually start with the syllabus and say what we are and all that, but we're in chapter 13. We've taken the first exam. We're moving our way to the second exam, which is not going to be till week 11, which is, I guess, 3 weeks from now. So we've got some time to spend on this topic, and I really think it's worthwhile. And I think it's to your benefit, and I personally think it's to your long-term benefit for us to really get into the idea of what cost, volume, profit relationships are all about, because it comes up all the time in business, whether it's in marketing, finance, wherever. Okay, so any questions about anything before we start today? Okay, well, let's pick up where we left off. So we were talking about cost, volume, profit, and let me kind of back up just a little bit here in order to go forward just a tad. So when we talk about cost, volume, profits, this idea of changes, and I think this key word here is changes in cost and volume and how it affects the company's profit. And remember, I said earlier on that in accounting, what is a very important relationship is this idea that we can change things and do what is. And management oftentimes tasks accountants to say, okay, what if we did this? What if we did that? And it's very often very finite in terms of, okay, this particular product, this particular department, etc. But it's really important in terms of profit planning and budgeting and forecasting. We're going to talk much more about a bit later. So I know I'm going back just a bit from where we left off, but it's a very critical factor in this overall scheme of things we call strategic management. And for those of you who are going to go on to do a bachelor's in business, probably you want to have some sort of course that's called strategic management or policy or something, but it's basically the same thing. That is, how do we decide where the company goes from here? Okay, so again, and I want to sort of review this. I think we left off here on Wednesday, is the idea of these assumptions have to hold in order for CVP analysis to be accurate. And it's the idea of cost of revenues are linear throughout the relevant range. And what does that mean? Linear means stable, it's constant slope. Think about a linear function. Any kind of linear function is the case in which if you go from one point to another, the rate of change is constant. So we're saying here in the very short run that these relationships are stable, both cost and revenues. Now, we haven't really brought revenues into the picture yet very much, and we're going to do that here today. Also, we can talk about costs that are either fixed or variable, and I think that's an important issue here. So remember, when we are sort of stepping back and taking a look at what we're doing here, is we're not really interested so much in product costs or period costs. And we define product costs as those costs which we attach to the inventory itself. And we can know what it costs to make a pair of shoes or a toaster or whatever. Here we're saying we don't really care so much about that. We are interested in the cost behavior. The behavior of cost. Is it fixed or is it variable? And we talked about what some of those classifications were. And then changes in activity level are the only factors that affect cost. So these are assumptions, what we like to call in economics conditions, which we have to sort of make sure we have that the only activity levels that are changing here are this changes in activity are the only factors. In other words, quantity. There are no unit cost changes or price changes. Now, what do I mean by that? I mean that there's no cost per dollar per unit of whatever it is we're producing that's changing. So we're assuming stability in the short run. Is that always a good assumption? No, it's not a good assumption in the long run, but the short run it is. And I know that when we talk about the short run versus the long run, it's always a very controversial topic. But the idea is that there are differences between the short and the long run. And that first, and we're also talking about no inventory buildups or drawdowns. And then finally, when more than one type of product is sold, the sales mix will remain constant. Sales mix is something we're going to come back to a little bit later. Let's kind of put that aside right now. So we're not going to really talk about that so much here, but it's very, very relevant to where we're going. Okay, so we have a quick review question. Which of the following is not involved in CVP analysis? So is it sales mix, unit selling prices, unit fixed costs, volume level activity? And so we're going to say it's unit fixed costs. And the reason why is this. Let's talk about why this answer is the way it is. We're going to assume here, as we do cost volume profit analysis, that whatever the fixed costs are more or less fixed and committed to, and that they're really not going to change. And what are we talking about? We're talking about salaries of managers. We're talking about things like insurance on buildings, and we're talking about things like depreciation on equipment. These are things that are not really going to go away. And so, I mean, in the long run, yes, we can make them go away. In the very short run, not so much. So we're sort of committed to these. So they're not really elements of decision making. In the long run, yes, we can make all kinds of decisions that we want to make about salaries and people and the facilities and whatnot. But in the very short run, not so much. So what unit fixed cost refers to as fixed cost divided by the level of output. That's really what's going on here. So CVP does not really take into account this very much. Okay. And no one's saying these are not relevant. But in fact, we'll come to the term relevant costs. And I know sometimes students will say, well, how is it not relevant if it's a cost? And we'll say, yes, it's relevant in the sense that it exists, but maybe not relevant to this decision. Okay. And that's really kind of where we're sort of going here. Okay. Okay. So let's talk about cost volume profit. And let's talk about the idea of contribution margin and what that's about. So we're going to construct a CVP income statement, which is very similar to a income statement you saw back in accounting 1. It's not quite the same though, because in 2110 we talked about the idea of a statement being conforming to GAAP, generally accepted accounting principles. We have a 3-step statement. We have sales, cost of goods sold, net income. That's one step, or gross profit. I'm sorry, as one step. Then we have operating expenses. Then we have non-operating items, and so we have a 3-step process. We're not really interested in doing that. And by the way, I come back to something we talked about very early on in this course, is that a lot of these statements that are produced are not for external use. They're really for internal use. So they're not for external users to look at. They're for management to look at, hence the term managerial accounting. So when we talk about a CVP income statement, what we're doing is we are splitting out costs as being fixed or variable. It's the behavioral costs that we're interested in here. Okay. So we're not really terribly interested in product costs versus period costs. We are interested though in splitting those up. And the key thing that we want to get to here is this idea of contribution margin. Contribution margin may be the overriding important issue of this entire chapter. So what is contribution margin? It looks a lot like gross margin, but let's not be confused because it's not. Okay. It's the amount of revenue remaining after we take out variable costs. So it's sales minus variable costs. Again, sales or revenue being the same thing, minus variable costs. And then what is left is what we call contribution margin, which we can express as a dollar figure, and we can also express it in percentage terms, and we'll get to that a bit later. But in terms of dollars, what does this term contribution really refer to? It means it represents the amount that is the sales revenues contribution to profit and fixed costs. So those are two things that are really interesting here, is the idea when we talk about contribution, it's contributing to what? It's contributing to fixed costs, first of all, and then to any profit. So this is interesting, and what is also interesting is the idea that contribution margin is relatively stable over time. And we said that one of the reasons why we said this is stable is because variable cost per unit is also stable. Remember, we sort of label variable cost per unit as a sort of flat line, and that it's in the short run it's very constant. In this case, it's also very constant. So what we're saying is contribution margin itself is this idea of what we have left over after we have sold the goods that we're producing with the services that we're providing, that provides some contribution toward fixed costs and contribution and profit. And by the way, the term contribution is used a lot in business world. It's used all over the place. And they're sometimes used at the division level, department level. It's often used as a determinant of officers' salaries and compensation and bonuses. And in terms of planning and budgeting, they're very often used exclusively. So it's an important concept, contribution margin. And so in this case, we're just talking about the dollar figure here, but we'll get to how we take the percentages and make those sort of work for us. Okay. Okay. So questions so far. Let's go to the next issue. So we've got we're back to our Vargo Electronics, and this is an example we talked about earlier, where this is a company that makes cell phones. And so in this case, we've got the selling price is $500, and we have these variable costs. And we then made these in green, so we sort of stood out here a little bit. So we got direct materials, direct labor, sales commissions. Now remember, we did not include commissions as a product cost because we said that these costs were not related to the product itself. We're going to sort of disregard that assumption. We're going to relax that assumption and say, okay, because commissions are variable, they belong in the variable cost category. So we're sort of diving our way into all costs and saying some costs are fixed and some are variable, some are product, some are period. What we're really trying to get at is this idea of dividing variable and fixed costs. That's really the main event here. So we have direct materials, direct labor, sales commissions, and sort of $300. So kind of remember that, and this is going to kind of be a theme for the next few slides here. And then we have fixed costs, and they're manufacturing overhead, and we're not going to get really too much overhead here. The CEO's salary and the sales salaries and whatnot. So these are the fixed costs, $200,000. And so again, fixed costs are simply those costs which do not vary with the level of activity. And in this case, the scenario given is that units sold are 1,600. Okay, so that's the scenario we're given, and we want to sort of run with this and do some things with it, and find out what's interesting about this. And so I think here's the thing that I think we should talk about here is the idea: can we construct a cost function? And I think we can. So why don't we do that? Let's so given the information that we just got here, what is total cost? These things, so what is a cost function? So remembering, of course, we've got total costs are equivalent to fixed costs plus variable costs. Pretty simple, nothing too complicated about that particular relationship, okay? But in this case, we're given that fixed costs are $200,000. And variable costs are going to vary with the level of output. So we can't say that we can really tie on a complete variable cost figure unless we know what the output is. And because output is variable, variable costs are variable. And so what do we know about this? We know that the cost per unit is $300 and $300. And so this is the relationship here. This is the formula itself. And so in this regard, we have what? We have 200. Let's just solve the problem. First of all, what is quantity? It was given to us as 1,600 in this scenario. Okay. So let's work the formula: 200,000 plus 300 times 1,600 is the unit quantity. So we do the math here. We have 200,000 plus 300 times 1,600 units is 408,000. And these are all dollar figures here. So we have these up. We have 608,000. Okay. And that's the total cost of production based upon that particular scenario. And I'm spending some time really talking about this and tearing into it because it really represents the example that sort of flows throughout this module, this idea of a company making cell phones. We have some fixed costs, we have some variable costs, but this is the formula. And remember this idea that it looks like a linear equation, right? Of the form y equals mx plus b. And the idea is that maybe we have these terms on the right inverted a little bit, but it nonetheless is the idea that every unit we produce is going to cost us $300 more to produce that one single unit. Okay, so that's essentially what's going on with regard to that particular example. And we'll talk about some other examples here as we get going and talk about how they look like and what the mathematics behind them look like. And I want to be clear here, and I know sometimes not everyone likes the math part of this. And I really do want to try to make the math apprehendable and whatnot. I really don't want to get too far out in front of everything here. But it's really important to understand the idea that we deal in numbers, but we don't deal a lot in math. That sounds like a complete contradiction, and I get that. It's not higher order mathematics. It's simply we deal in numbers, and the math is a tool that allows us to get to where we want to go, and that's maximizing profit. Okay. All right. So let's go to the next issue. All right. So we talked about CBP income statement. So what is it? All right. So an example here. So here's a GAAP income statement, and it kind of follows. It's not quite the full income statement because it's the top line sales, cost of goods sold, and they've broken up into three components: direct materials, direct labor, manufacturing overhead, which we talked about, and gross profit. And that's the first section of a GAAP income statement. Then we have operating expenses. What is missing here is non-operating items, but it's not really important. So the idea is we've taken all these into account, and we had 800,000 in revenue minus 496 in total direct costs, cost of goods sold, which gives us 304. We take out operating expenses, a lot of which are dealing with things which are not items which are not really directly related to the production of the good itself. And we talk about sales and sales commissions and sales salary. And we said earlier on, we've divorced these from the idea of product costs because we said they're not product costs. And so as a result, we end up with net income of 120. Okay, that's what we've seen before. Let's move over here to the CBP income statement. And what we're doing here, the big thing is we're separating variable and fixed costs. Whatever the costs are, it's the behavior of the costs, not the costs themselves, that are really the issue here. So what we're trying to do here is to try to split these up. And one thing I want to sort of point your eyes to is the idea of gross profit here on the GAAP statement is 304, and contribution margin is 320. They're not the same. Contribution margin and gross profit, they look a lot alike. In fact, a lot of people confuse them as being the same thing, but they're really not the same thing. And the reason they're not the same thing is because whatever kind of overhead and whatever, all we're really doing here is we're simply separating variable costs from fixed. They're going to be close because, frankly, a lot of these costs are variable. And by the way, manufacturing overhead, which we've sort of talked about already, and we're saying it's mostly fixed already. We'll get into that a bit more later, but they're not the same thing. All we're doing is we're sort of separating these. And so contribution margin and gross profit, they're similar, but not the same. So what is contribution margin? It's the dollar figure that allows us to contribute, hence the term, to fixed costs and to overall profit. And so in this case, fixed costs, which we've carried over manufacturing overhead, 40,000, sales salaries here of 10,000, and the CEO salary. And that, for whatever reason, textbooks like to include CEO salaries. And so you get to 120. You get to the same place. Nobody's revising the rules of accounting. Nobody's revising the rules of mathematics. But what we're doing is we're simply saying, okay, if we're looking at contribution to profit, then what are we really getting at here in terms of fixed costs and variable costs? And this is going to become more illuminating, I think, as we get going, because we're going to talk much more about this idea of break even. And break even analysis is really an important piece of this. Okay. So gross profit is not the same as contribution margin. And by the way, one final thing I'll say about this before we move on is this is really a GAAP concept, and this entire issue is produced. These statements are produced according to GAAP. That is, they follow the same sort of format. But here in slide B, or exhibit B, it's not according to GAAP. It's internal statements, and these are produced for management so management can understand what's going on, and they very often like to see what the breakdown is between fixed and variable costs. Okay, so we get the same place, but we are dividing the costs up differently. Okay, so if contribution margin is a dollar figure, we can simply make it a unit dollar figure by simply taking the sales price minus the variable cost per unit and getting the contribution margin on a per unit basis. So all we're doing here is we're sort of breaking down this concept. Before we had total sales minus variable costs equals contribution margin. Here, we're taking down to the individual unit by dividing everything by the number of units that were produced and sold. And we're going to say produced and sold. We're making the assumption here that we're not producing and having anything stored in inventory or whatnot. Everything it produced is sold. That's the assumption that we're sort of going with here. Okay. So if we go back to that, think about what we got going on here. We have selling price 500. We have variable cost of 300. And so as a result, 500 minus 300 is 200. Okay. So it's not particularly complicated in this regard if we can account for what all the variable costs are. Okay. All right. So, and we're going to do a lot with contribution margin. It's a pretty important feature of this. So if we go to this issue of Vargo Electronics, we have a CVP income statement. So what do we have here? We have sales. Remember, the selling price is $500. We sold 1,000 units, so 1,000 times 500 is 500,000. And so the price per unit obviously is 500. And then we have variable cost of 300. So 1,000 times 300 is 300,000, which gives us a contribution margin of 200,000. Okay. And then we have fixed cost of 200,000, which gives us a net income of 0. So why do we care about a zero income proposition? In other words, we're talking about break even. And this is really important because it's really sort of the critical piece of what we're trying to do here. We're talking about a quantity which net income is 0. So let's kind of do some of the math here, okay? And talk about what this looks like in terms of profitability and using the equation of cost that we already looked at. Okay. So, okay, so what do we have here? So think about this. If we have sales, right, which is sales, which we're going to say is equivalent to total revenue, right? So again, revenue and sales are more or less the same thing, right? And we have minus total costs, right? These are total costs here. Gives us what? Gives us net income. Okay. And what is simply called net income over here? Okay. And for right now, let's disregard taxes. We're not really interested in that. Taxes are a whole other issue altogether. So, but what is revenue? Revenue is simply the price of the good times the quantity of goods sold. So P times Q is the relationship of what total revenue is, right? And then what is this issue of total cost? We have to subtract out fixed cost and variable cost in order to arrive at net income, right? So net income is simply the difference between inflows and outflows. That is price times quantity, which is the revenue being generated minus fixed and minus variable cost. Okay. In this case, what do we have here? We have selling price of $500. And the quantity, 500. And the quantity is, well, it's going to be variable. We'll plug that in a bit later. And when we talk about variable, let me just sort of move this around a bit here. See variable cost and fixed cost in this direction here. We have variable cost of $300 per unit, and then we have fixed cost of $200,000. And equals net income Now here we're saying net income is 0, okay? And there's a reason why we're gonna go with this particular assumption that net income is 0. It really is gonna matter here in just a second. So let's kind of do the math here. So 500Q minus 300Q is 200Q. Okay. And 200Q minus 200,000 equals, oops, minus 200,000 is going to equal net income. And we're gonna say net income here is 0. Okay, and we're gonna get to the reasons why here in just a second. So we want to move 200,000 over this direction. So if we add obviously 200,000 to both sides, we have 200Q equals 200,000. All we're doing is simply canceling this out, moving this over here. And Q then is 1,000. And so what is this quantity that we're talking about here, that quantity of 1,000? It's in this particular example, the Vargo electronics example, we're saying this is the point at which we have reached the break-even point. And break-even point is expressed either in dollars or units or whatever you want to say, but dollars and units are really what we're getting at. This is the point at which this company can produce no more output to produce this idea of 0 income. Now, break-even is an important relationship, and the reason it's important is because of the fact that I know it seems like with a mature company, you're not really interested in getting to a 0 profit or net income. That doesn't seem to make a lot of sense. Why do we care about 0 income? We're here to make more income. That's true. We'll get there, okay? But it's important, particularly in the sense of decision making, where we have a new product that is slow to get off the ground, and we're going to get these sales up. We're going to get the quantity up, and how do we get to break even? That's a really super important question. How do we get to break even? And the history of business has lots and lots of examples of where companies just simply are starting to get going and they can't get to break even, and it takes them some time. And it's really an important question as to what we do to get there, right? Or, as we'll see a bit later, on the other side of the equation, a more mature company that's been around for a long time is now saying, our sales are falling, our quantity is falling, and where do we break even? How far can we go? And in fact, what is our margin of safety? So these are some elements that are going to be coming up here very quickly, okay? So break-even point is an important concept in accounting and finance, because it really tells the company where you can be in order to just break even. And we're not going to get into more complicated issues of what we might dump into variable cost and fixed costs and whatnot. That's really not our point here. If you want to take further accounting courses, you can do that. But we're going to assume it's $300 for a cell phone, was it cell phones, right? And 200,000 total fixed costs. And we'll sort of leave it at that in order for us to sort of isolate these costs with this particular output. Okay? All right. So questions about that before we sort of move on to the next level here. And if you don't have this already, those of you in the classroom, you can take a picture if you like, or whatever. I'm going to be doing some erasing here in just a second, but that's really the important thing. So in terms of this idea of break-even. So let's talk about break-even. And oops, what did I do? Let's bring it up. Okay. So in this case, we have net income of 0. Well, net income of 0 implies 0 profit, which means break-even. So in this case, we've arrived at the same sort of values. And in this example here, it says, what if we did 1,001? That's one more unit. Well, one more unit would give us net income of $200. And that's not a mystery as to how we got there. Contribution margin per unit is $200. Why? Because we sell for $500. It costs us $300 to produce it. So therefore, it means $200 is the amount available for contribution. So our net income goes up. And I know one particular cell phone is probably not a big issue here, but it really sort of highlights the idea that we've got a relationship between sales and costs and what we do with this idea of contribution margin. So in this case, we have one additional unit, and then one additional unit does play a role, okay? So one more addition to this makes sense. But by the way, before I forget, I want to do this because I think it makes sense here. But I talked about this idea a linear function. And when we, okay, I guess the thing's not cooperating. All right, so we're talking about a linear function. What are we really talking about here? I said that when we have a straight line relationship, linear, which is really a short-term concept. In fact, in the long run, we said earlier that in the long run, all costs are variable. So the straight line relationship looks good. It's something that's sort of man-made. It really doesn't exist in the real world in the very long run. But in the very short run, we can make assumptions that make sense. Because the short run is mostly stable. And we know this from our own lives. We know that if we get up in the morning and we know where our toaster is and our coffee maker, that's pretty much clear, right? In 10 years from now, who knows what it's going to be, right? And so as a result, things are fairly constant. So if we talk about the sales function here, what are we really talking about? The formula for the sales function is basically this: total revenue minus total costs, right? And so fixed costs are always going to be linear in this range. And when we talk about what's going on here, we're saying that fixed costs are going to look like this, and they're going to equal $200,000. Okay, the output level is going to go like that. So remember, this short run issue of linearity assumes that we have a constant amount of cost per unit, whether it's fixed or variable. And so in this case, we're saying the fixed costs are fixed. Now remember, in the long run, we got to this last week, we said in the long run, these costs are going to take a jump or a step over time. And it's going to look a lot like a step function, and it is. So we can't get too comfortable with the idea that that we've got this idea of constant costs forever. And this is something I think that it bugs a lot of people. And in all the years I spent in management, a lot of people were really worried about the fact that we can't control fixed costs. And one element of fixed costs is salaries. And what do we do about that? And we'll talk a bit more about that in a second. Okay. So let's go to the next issue here, which deals some more with the element of contribution margin. And so let's talk about this idea of, where are we here? Okay, oops, went too far. So we have contribution margin as a dollar figure. So what is the contribution margin? We said it's a dollar figure, first of all, okay? That is, if we sell 1,000 units at $500 a piece, we have 500,000 in revenue, okay? And notice what we're doing here. There's a reason why we went back to this issue of ratio analysis. We're common sizing, right? So total sales or net sales, 100%, right? And everything below that is an expression of sales, including variable costs, which are 300,000 because it's $300 per unit times 1,000 units. 300,000 divided by 500,000 is 60%. So that's a ratio. And then the big issue here is this contribution margin. So 500,000 minus 300,000 is 200,000. If we take 200,000 divided by 500,000, we get 40%. And we call that the contribution margin ratio. And sometimes we just simply express this as CM percentage, okay? It's simply, and ratios and percentages are kind of used interchangeably. Again, we have all kinds of terms for the same thing, but it's a 40% contribution margin ratio. And what does it mean? It means for every dollar of sales, we have 40% or 40 cents dropping to the bottom line. It doesn't drop all the way to the bottom line because we know we have other costs involved here, including fixed costs, things like rent and lease expense and all that. But it means that every dollar of sales, we earn 40 cents on it. And that's an important thing to know there. And if we have fixed costs of 200,000, we have zero net income, okay? So in this case, what we're trying to discuss is the idea that contribution margin is not just a dollar figure, it's also a percentage. And so if you take this contribution margin and divide it into the selling price, we get 40%, which is exactly what we've done with common sizing. And that's really what common sizing relates to, particularly on the income statement. We talked a lot about that a bit earlier, and important as to why that is. And one thing we can say about this as well is, if you wanted to sort of break this out a bit, that contribution margin ratio, or percentage is also equal, in this case, to selling price minus variable cost over selling price. Okay. Obviously, we're breaking it down to a unit cost here, or unit level, selling price minus variable cost over selling price. We're simply saying, what is this? This is the margin, the contribution margin per unit divided by the selling price gives us a percentage. And that percentage will allow us to do a lot of things as we go forward, and we're going to talk about that here shortly. Okay? So that's what's going on there. So any questions about CM ratio and what that is? Okay. All we're simply doing is taking the percentage here based on the common sizing. So if we go back to the CVP income statement, all right, what do we got here? So we have all the values we had before. This is a company that's not making money on this product. And I know sometimes we were tempted to think, oh, this company's not profitable, zero profit, they're going bankrupt. Well, it could be this is one particular unit or one particular product line that's being sold. They could be doing a lot of other things as well. And so as a result, maybe they're patient and will wait for profitability to come, even if it's zero net income. And that's a very common scenario where companies, in fact, not only are they zero, it's negative. We have net profit for a very negative net profit for a very long period of time until they get going. And the business world is chock full of examples of companies that take time to get going. And the reason they take time to get going is really this idea of unit production. Okay, so in this case, we have this, we've seen this before, everything's the same. So we go back to this idea I talked about before, and it's a what if. So what if we increase sales by 100,000? Assuming again that our cost structure is stable, okay? That is, contribution margin is stable and all that, which means variable costs are still 60% of sales price. Contribution margin is still 40%. So what if we amped everything up and said, okay, what if $100,000 more in sales? And so still $500 per unit, $300 per unit, variable cost, still the same contribution per unit, 200,000. So nothing has changed except what is going on with the bottom line is net income has increased by 40,000. So we're above break even, we're selling more, and so we're expanding net income simply because of the fact that we're expanding our sales. This is why companies, it's not some great secret, why companies are desperately looking to increase sales all the time, particularly if they're trying to move away from break even. And the big thing here is this idea of fixed costs, which, fixed costs we're going to assume are 200,000, and in the long run we can expect that to go up probably if production expands. But that's really what's going on there. Okay, so this is an example of this. By the way, think about this: if contribution margin per unit is 200, and we're expanding production 600,000, well, how many? That's 200 units. So 200 times 200 is 40,000. So, and all we're doing is we're simply saying, okay, if we do this, this is what we get. And that's the what if kind of scenario that comes up all the time, everywhere in business. We're always trying to find out what if. Making some assumptions as to costs. And again, assumptions are sometimes problematic because they don't always work out to our expectation. But in this case, it's a very simple matter of taking the contribution margin per unit times the increased number of units to get to 40,000. So that's a relatively straightforward sort of issue there. Okay? And basically, the formula we can use here looks something like this. And I'm going to go to change in profit, right? The delta symbol is simply a change in profit, which is basically this. It's basically contribution margin per unit times the quantity. Okay. And in this case, we're operating at a quantity that's greater than the break-even point. Okay. The break-even point, which we're going to express in terms of quantity, we're above that, so we're making a positive net income. Change in profit is this contribution margin per unit times the quantity per unit, and that's what the change in profit is. This is an important formula that kind of allows us to do this. And in the real world, what it comes to do is plug this into Excel spreadsheets. And Excel is sort of the default standard for what we do with a lot of this kind of stuff, but it allows us to answer the questions of what is. And accounting staff are all the time being tasked by management to decide to estimate what's going to happen if costs stay the same. It's a big if, and I know it's a big if, particularly in this environment when prices are rising, hence costs are rising. So it makes it a little bit dicier. In most of my career, prices were more stable. And even though when I first started as an undergraduate, prices were not stable, and things were rising dramatically. It's more of a challenge. It really is. It really becomes the fact that do you do an annual budget, which assumes things, which may not be the reality. And so it's a difficult sort of proposition. Okay. All right. One final bit before we sort of move on here. Now, this contribution margin is what? It's revenue remaining after deducting variable cost, may be expressed as unit contribution margin, is selling price less cost of goods sold. And the answer to that is A and B. It's not selling price less cost of goods sold. Why? Because cost of goods sold is a GAAP concept, and we're not talking about GAAP accounting here. In fact, most of what we're doing in 2020 is not related to GAAP accounting at all. We will link it back to that just to sort of show and highlight the differences, but we're talking about internal reporting to management, and so as a result, that is not the correct way to look at that. Okay. All right. Any questions before we move on to the next set of examples here? Because I do want to. I know I spent a lot of time in this particular chapter because I think it's really critical for us to understand what's going on with regard to sales price and unit contribution margin and all that. So any questions? I'm kind of looking at the chat box here and seeing if there's anybody who has questions. Okay, let's talk about this next example. This is a different example, all right? It's Amco Industries. And I don't always spend lots of time talking about the do-it examples, which sort of come at the end of every learning segment, but I think these are important so that we can get more examples and more of these worked out in our heads. Amco Industries produces a cell phone operated thermostat. Okay, so it's Internet of Things information regarding the cost and sales of thermostats during September. 1 month, right? Or this. So we got selling price is 85, variable cost per unit is 32. Total fixed cost for the period in question is 190. And we're saying we sold 4,000 units. So do a CVP income statement for Amco for the month of September, provide total and per unit and 1% of sales. Why don't we do that? So I'm going to bring this up here and do this example because I think this is a worthwhile example of what we're trying to get at when we talk about this idea of arriving at contribution margin and what to do about it. So I'm going to go ahead and erase some of this here. And let's do this particular example. I know it's not the example we've been sort of following, but it's fine. We're gonna work this one and see what it looks like. All right. So what do we got here? We're given in this particular case. Let me just bring it up here. I want to make sure. Okay, $85 sales price. Okay, so all right. So let's do this. Let's do a CVP income statement, which again is not a GAAP prepared statement. It's a statement that splits up fixed and variable costs. And so let's do sales first. Okay. So we have sales here, which is basically what? Price times quantity. And we have $85 is the price. It's a dollar figure times the quantity, which is 4,000 units. This is all given to us. So as a result, sales or revenue, whichever you want to call it, is 340,000. Okay, 85 times 4,000 is 340,000. Again, this is a CVP statement. We're trying to split up variable and fixed costs. So let's take out variable costs. And variable costs, which is essentially variable cost per unit times units, right? Makes sense, right? Total variable costs are per unit times the number of units themselves. Then again, the Q here is simply units. They're simply units of output, okay, whatever it is. In this case, it's $32 per unit times the 4,000 units. And so as a result, we have, what do we have? I guess we can kind of do the math. We have 128,000. Okay. So 128 is the total variable cost. And so as a result, we can do the math here and say, okay, contribution margin, CM, which is a dollar figure in this case, is 340 minus 128, which is 212,000. Okay. And then we're given fixed costs, which are 190. So contribution margin minus fixed costs gives us a net income figure. And again, let's disregard tax and let's not worry about that so much. We're going to get 22,000 as a net income figure. Okay. So what are we saying here? We're saying at the $4,000, or I'm sorry, 4,000 unit level of production, assuming fixed costs are constant, which we're assuming they are, that if we do the math here, we're going to have price times quantity, we have variable costs, we have contribution margin, we're going to have $22,000 of income. Now, by the way, I know that sometimes we sort of present these relationships in accounting textbooks as being a company that produces one single good, and that is it. And yet, I think a more realistic example is the fact that maybe a company, this is one particular good of 37 or 370, who knows, products that are produced. And so as a result, we need to know what we're going to make on this particular output level based upon the costs which are absorbed into it. And by the way, it's even though we sort of seem like we're departing from chapter 12, we're not really capturing absorption costing. We really are. We're not. The only thing about job order costing is we're attaching cost to every individual production unit, and we're not divorcing ourselves from that particular issue here. It's that we're simply saying we're going to split up fixed and variable costs in order for us to do what we have to do. Okay, and that is to manage our business to maximize profit. So what do we end up with here? And I've done the math already for you. But oops, sorry, let me kind of bring this down here a little bit. The only thing that's different, oops, oh, I think sorry about that. The only thing that's different here is that we have that the textbook authors common size differently, and that's good, right? So common sizing based on sales, 100% of sales, everything's in relation to sales. We have variable costs, we have fixed cost, we have contribution margin, and we have net income of 22,000, right? Same math that I just did. What I did not do was this issue of common sizing. And common sizing is used all the time, particularly to get to this guy here, which is contribution margin percentage. And that's an important one because it really lets us decide the what ifs, and the what ifs are all over the place. Okay. All right. So any questions about that? Anybody on the Zoom call or in the class? Have questions? I've got about 20 minutes left, and I want to kind of move along. And I know I'm taking some time on this particular module because it really, to me, I'm just for your benefit. Really, I think it's important to take time because these are really important concepts. And so let's get to these important concepts. Number one is break-even point. I've kind of gotten to this point already, where we're saying break-even point is the point at which net income is zero. That is, if we take into account all the sales minus variable costs and fixed costs, we have zero net income. Let's not worry about tax here. We're simply not worrying about that at all. And so what do we have here? Break-even analysis is what? It's essentially a process, and it goes on all the time within organizations where, and it's oftentimes, I think it's probably best viewed as being applicable to startups or to individual new product launches where we're just trying to decide where do we get to break even. Keep in mind, there are a lot of companies, there's just a ton of companies out there that have survived the period in which time net income was zero. Amazon made no money, negative income for year after year after year. Today, Amazon's making gargantuan amounts of money. Genentech, a drug company, made no money for years and years and years. And it goes on and on and on. And it's because they have to get to the point at which the activity level, the quantity, gets to the point where they get at least a break even. And then obviously we don't want break even, we want net income. That's positive, that's the goal. But there are lots of examples of companies, not to say individual products themselves, which are not profitable for a very long time. So, and we've really got three different ways to compute it. We're going to talk about a mathematical equation, which we got into a bit. We're talking about contribution margin techniques, which really sort of involve the mathematics of contribution margin in relation to sales, both on an aggregate level as well as a per unit level. And then a CVP graph, which I think is really interesting and kind of cool because I know a lot of times people like to see things graphically, and it's a good way to view things. And In Excel today, you can do a lot of this, all this stuff can be done in software. You don't have to do it back in my day where we all did it by hand. And we're going to talk about break even as either a dollar figure, or I'm sorry, a unit figure, or in terms of quantity, or a dollar figure. So units or dollar figures. Different ways of sort of expressing this. And so let's get into it. Let's talk about what's going on here. So here we got this is the example of the Vero, what's it called, Vero? And it's the very same formulas that we used before. And so nothing really new here. We have the sales formula, which I gave you earlier, 500Q, which is $500 per unit. Price times quantity, right? Price times quantity is revenue minus variable cost, $300 per unit times quantity, minus fixed cost. In this case, it had to be 0, so we're setting it to 0. And if we do the math here, we simply can reduce this to 200Q by subtracting these and moving this 200,000 over to the right side. So we end up with 200,000 divided by 200 is 1,000 units, because the Q's will cancel out. So the what's going on here is the idea we get to a break-even point, which we already saw before. This is sort of a rehash. It's a little bit exaggerated, but it's a rehash of what we've done before. But here's the important thing: it's this thing which is in red, and it's the idea if we take fixed cost over the unit contribution margin, we get the break-even point. So one thing I should tell you, in your white space course site, you got this guy here. It's a cheat sheet. Use this thing. It has all these formulas that are laid out for you, and it's easy to look at. So in this particular case, we've got what? We've got break-even fixed costs over unit contribution margin, and it gives you the quantity of break-even. And so use this. And I forget what that link is, but if you have questions on how to get to it, it's in the chapter 13 module itself. So I would print this off. I printed this off years ago, and it's important to sort of have that. And you can use it. And the good news is with exams, even though some of the language in the syllabus says these are closed book exams, they're not really. So quantity is 1,000. Okay, where Q is quantity units, $500 is selling price, 300 is unit variable cost, and 200 is fixed cost. Okay, and these are not per unit fixed costs; these are all unit costs. So this gets us to break even. Okay, all right. What about this particular formula? This particular relationship makes sense. And that is that when we talk about contribution margin, we have different ways of computing break even. At the break even point, we're saying contribution margin must equal fixed cost. How do we know that? Well, let's go up here and take a look. Back to our example here, right? And this is maybe not the best. Where's the best example here? This is probably the best example where contribution margin and fixed cost are the same, so net income is 0. Remember what contribution margin is what does it contribute to? It contributes to the covering of fixed costs and net income. In this case, it's contributed fully to the covering of fixed costs and nothing to net income, which means it's the break-even point. So it's where contribution margin equals fixed costs is a break-even scenario. Okay, and that's really an important thing for us to be cognizant of here is this particular relationship. Okay. All right. So the break-even point contribution margin must equal total fixed costs. Meaning the total revenues plus total variable costs are the same. And all we're doing here is simply reworking the terms of the equation, right? If contribution margin is sales minus variable cost, then total revenues minus variable cost is contribution margin, right? That's what we're saying. So the break-even point, which is the 0 net income proposition, can be computed either using the contribution margin in terms of dollars per unit, contribution margin dollars over the contribution margin per unit, or as a contribution margin ratio, which we got to earlier by saying in the Vargo example, it's 40%, right? It was 40%. So, all right, so when the break-even point in sales is desired, and I know this sounds like a sort of a crazy proposition. Why would you desire a break-even point? Well, maybe not at the break-even point yet. And so you want to get to the break-even. A lot of times new products are launched, new divisions, new whatever are launched, and the idea is you got to get to profitability or at least to break even. In other words, earn your salaries and earn your, justify your existence and whatnot. So it is sometimes desired to get to some point volume. In this case, the volume is 1,000 units. That was the break-even point. How do we get there? Fixed costs over unit contribution margin equals 1,000 units, and that, again, we're resetting all this in a lot of different ways, and I kind of get that. And if we go all the way back to, I'm not going to go all the way back, but it's unit contribution margin. Well, we had $200, right? That was the unit contribution margin we had. We had fixed costs divided by unit contribution margin gives us 1,000 units. And so this is what accountants like to call a quick and dirty way to get to the break-even point in terms of units. And so it's simply the where's my eraser here? The calculation is very simple here. And it's fixed cost over CM per unit. Contribution margin per unit. And this is kind of in your cheat sheet here, but kind of be aware of where this is here. This idea of the break-even point in units, right? And we're talking about break-even point in terms of quantity. It's fixed costs over the contribution margin per unit. In this case, it's $200. Okay. And that's an important relationship. It's one that I think you want to sort of put a star by and highlight. And it's going to be one you're going to be using as you get going throughout the term here. And so we just still do the math here. We had, in this example, we had 200,000 divided by the contribution margin, which was 200. And we reduce that and we get to 1,000 units. And it's a quantity of 1,000 units. So that's the break-even point in terms of quantity. Break-even point in terms of quantity, 1,000 units. Okay. And a break-even point, again, I know this, we're kind of going in and out of different denominations, dollars and units and whatnot, but things can be expressed in unit terms, in dollar terms. And the math to how we get there can be in terms of dollar figures or whatever. And by the way, I want to take a little bit of a sidetrack here, okay? Because we've got a break even going on here. And the question is, okay, why do we care about this? And we might care particularly, so let's say we get to break even, okay? We're starting a new product line and we're getting to break even point. And the question becomes, okay, why do we care about break even? And we might care about it because we might make a change. And I think this is an important assumption for us to make, is that management can often make changes to the setup of the cost structure. So in this case, let's say that what if, and again, I do like to point out the what ifs here. What if management decides to hire a salesman? And let's say we're going to pay that guy $100,000, okay? All right, so let's do that. So we're going to raise our everything up here. So in this case, what are we thinking about doing here, right? So we have a $100,000 salary for a product manager to get this product to the next level. Okay, not an unusual scenario at all. Okay, so now instead of 200,000, the fixed cost are doing 300,000, right? Again, fixed cost over the contribution margin percentage. In this case, we're going to keep the same dollar figures. Let's just do it in dollar figures here. And so as a result, we end up with what? We end up with a unit, break-even point in units of 1,500 units. So we've added, again, fixed contribution margin per unit is unchanged in this relevant range. The relevant range is still constant, right? But we've added more fixed cost, $100,000 to pay for this person who's now managing these. And so now we have to do 1,500 units. In other words, a 50% increase in sales. And this is an extremely common scenario where management says, okay, what do you think you can do? And when do you think you can do it? And how do you get to this new level of output? From 1,000 to 1,500, that's 50% increase in sales. That's not terribly unheard of, I guess, particularly, if we're talking about small dollar figures. But it's a very common scenario. And this is something which I personally think is important for students to understand in managerial accounting is that what we're trying to do here a lot of times is to sort of evaluate managers, their effectiveness, whether they're being compensated fairly or unfairly, and to sort of evaluate the overall effectiveness of what we're doing. Breaking this down on as micro a level as we can. Okay, so all I'm really doing there is simply doing a what if. And that is simply saying, okay, what if we added a fixed cost? And we're assuming we can salvage our fixed cost. We're assuming we're paying this person $100,000. Okay. All right. So any questions so far? I don't want to go too fast here. I've got kind of got a motivation to move a little bit quickly just because this is such a big chapter here. So all right. So number 58 and the slide here, contribution margin technique. So we've talked about it from one particular angle. We did it in terms of units. We can also do it in terms of dollar figures. And so if we're doing dollar figures, we're going to use the fixed cost, not same dollar figures, and we're going to use not the dollar figure, but the percentage, which was 40%, right? Of contribution margin, that is 100% minus 60% is 40, and we're going to have the break-even point of sales dollars is 5,000. So break-even point is expressed both in terms of units and in terms of dollars, and so we get there in both directions. Okay. All right, and then the final technique is using this thing, which is a graphic method. And the graphic method, I kind of like this because it's just kind of interesting. It's the same Vargo electronics example. Well, the break-even point is sales dollars in thousands, 500,000 here. And notice what's going on here. Sales just at 0 units, obviously 0 sales. And it goes up at a linear rate, right? At a rate of the dollar cost per unit, or the dollar per unit, $500 per unit. Notice the fixed costs are right here. So if you don't get to this area here, you've not even covered your fixed costs. But here's what's most important is this area here. We got the break-even point, and every dollar beyond the break-even point expands your contribution margin. And this is it's a powerful visual of what is really going on in business. Is the idea once you've gotten down to break even, particularly the larger your contribution margin percentage is, every unit of output produced just expands and drops to the bottom line. And as a result, this goes up and up and up. Now you can measure this, mathematically by. I mean, this is a triangle, so you can simply do the math here. It's not particularly complicated. It's actually a right triangle. Let's not get into that. All I'm simply saying is this thing goes up and up and up as you push outward. And sometimes it is the case where businesses that have a very fat contribution margin per unit will go out of their way to sell some units because they know that they've long ago crossed the break-even point, and the more they sell, the more they make, and it all falls to the bottom line. And when I say fall to the bottom line, it's simply that's sort of an accountant's expression for working its way down to the bottom line on the income statement. Okay. So that's a sort of a graphic example of what's going on there, and it sort of helps us to sort of visualize what's happening. So this company, we got a quick question here. We've got Goss and Company is planning to sell 200,000 pliers for $4 per unit. Contribution margin ratio is 25%. If they'll break even at this level of sales, what are the fixed costs? Okay. Well, real quickly here, without spending a lot of time here, we can simply do the math and say that, I keep losing my eraser. And sorry about that. And I want to kind of do this because I think it sort of bears repeating. It's got some emphasis here. So let's find out what are the fixed costs. And we're going to sort of rework this particular formula here to get to it. So what do we know about this? We've got 200,000 units that are being sold here. Okay, so the quantity is 200,000. That's what's given. And we know the price per unit is $4. Okay. And so price times quantity, which is revenue, right, is 200, well, let's keep the same order here, $4 times 200,000, which is going to be 800,000. Okay. And what what are they asking us here? They want to get to our fixed cost here. So in this case, what do we have? And I don't know that I have enough room here, but we have what? So the variable costs are basically this. They're equivalent to the complement of the contribution margin percentage, which is given to us at 25%, which basically equals 75%, right? That's the variable, the variable cost per unit, which if you take a look at this, it's 0.75 times 800,000, which is 600,000. And I'm going to sort of bring this slide up here a little bit here in order to arrive at fixed cost. All we're doing is simply reworking the formulas. We're not reinventing anything. We're not making up new formulas. We're not doing that, simply reworking it. So let's pick up from where we left off here. So we have variable costs of 600,000. Okay. So let's kind of do this. All right. So we have variable costs of 600,000. And so in this case, what do we have here? Let's go back to the original formula of total revenue equals, I'm sorry, total revenue minus variable cost equals fixed cost. And how do we get to that? We simply say, okay, if total revenue is equivalent to variable cost plus fixed cost at the break-even point, and we're saying in this example we're at the break-even point, right? Then what do we have here? So we're saying that where sales is total revenue is price times quantity, and we're going to subtract variable cost, and we're going to subtract fixed cost, and that's going to be 0. Okay, break-even point. Sales minus variable cost minus fixed cost. Inflows minus outflows, the two components of outflows. And so in this case, what do we really have? We have variable costs. We have sales of 800,000, right? We have variable cost of 600,000. And they must equal 0. In this case, the answer is 200,000. 200,000 must be fixed cost. Okay. That's the only answer that will work on that particular formula. And all we've really done here is sort of reworked the math to accommodate this. And I come back to something I've been saying for a very long time in this course and a lot of other courses, is sometimes the best way to sort of work these relationships is simply do the problems. And we have ample numbers of problems in the back of every chapter that you can work, and click on the little blue button for the answer and whatnot. If you don't have the right answer, don't freak out. It's part of the process. It is what it is. And so, so this is a pretty good stopping point, I think. We've still got some business yet to do here because, oh, by the way, there's the answer for 200,000. Oh, you don't have the slide up, but so the answer was 200,000. They got that same way than I did. So we've got really one more thing to get to, and that deals a lot with more of these issues of what ifs. And so I think we'll pick this up then on Wednesday and we'll talk more about it. But are there questions right now about anything that I've talked about so far today with regard to break even, why it's important, and why this idea of cost, volume, profit is such an important relationship? Okay, well, I think that's it for the day. So we come back on Wednesday, we'll pick this up, and we've got one final bit to go over. We got, well, we should be able to easily accomplish it, and then we'll talk more about the chapter 13 homework quiz and bonus. So everybody have a great rest of your day. See you next time.